Howdy guys, 2024 is here and this year is going to bring some changes to the real estate industry, the real estate market as always, and I want to talk a little bit about what I think might be coming in the market over this next coming year. So if you've been following the real estate industry at all over the last 2 years or year and a half at least, there's been a lot of talk about the interest rates because for the first time in quite a while, they've moved quite a bit up. So at the beginning of 2 years ago, the interest rates were really cheap depending on the loan terms and the quality of the buyer. People were getting loans in the 2s and 3% for quite a while, which is historically really, really cheap. And so in 2022, the interest rates started moving up steadily and not particularly slowly. They moved up fairly regularly and continued to do so for some time. And so by the end of 2022 and most of 2023, the interest rates were a lot higher than they had been for quite some time. So instead of being able to get loans in the 2 to 3% or maybe 4%, a lot of people were looking at like the 6s and deep into the 7s even. And with investment loan products, a lot of times they were into the 8s or more. So investment products are always more expensive and they're harder to get, things like that, or depends on the circumstances. But the point is, with the interest rates having moved so far, the affordability for regular homeowners went down quite a bit. Now, the idea was to put a slow on the inflation kind of across the board, and it did slow the rapid inflation of the real estate industry, but most real estate markets still did go up in value, just quite a bit slower than they did in 21 and 22. And so the Fed finally decided to maybe ease off of that a little bit. I'm sure it has nothing to do with the election year coming up. But anyways, the interest rates have came down already a few times in the last 6 weeks or so. And the forecast is that the interest rates will be coming down probably for at least half of this year and maybe even further into 2024. We'll see how it goes, after the elections and stuff. But the point is, our upward interest rate climb there is going to taper off and turn around, is what most economists think. It's what the Fed has told us. So we are expecting interest rates to start moving downward. So here's what that means. As the interest rates were moving up, every movement on the interest rate, even slightly, makes it more expensive to buy a house. And to qualify for a house, you have to have a certain debt to income. So like, how much debt do you have compared to how much income do you have? Can you afford this mortgage? Remember, if you're buying a house and you're not paying cash, if you're getting a loan, you're buying two products. One product is actually the home, but another product that is significant and expensive is actually the mortgage, which is the opportunity to own that real estate. So even if the real estate stayed the same, which it didn't, it crept up slightly, when the interest rates crept up, the affordability of homes plummeted, especially for folks that were on the verge of qualifying. So many people got kicked out of qualifying. Now that was expected, that was obvious, and everybody knows who's in real estate or finance that if the interest rates go up, they're less affordable. But here's something that we didn't expect or at least that, let's put it this way, a lot of people overlooked the fact that not only will buyers be dropping out of the market, but sellers would be dropping out of the market. I'll explain that in a minute, but with sellers dropping out of the market, even though there were less buyers, since there's less sellers, the supply and demand was still in imbalance, and that's what caused real estate to continue to rise in most markets. Now, it didn't across the board, didn't in some places in California. I think Boise took a loss, and some other markets that had hyperinflated, but across the board, real estate still went up in value in the US. So here's why so many sellers got out of the market and not just buyers. A lot of times when somebody's selling a home, most of the time they're still buying another home. They might be buying a bigger home because their family outgrew it. They might be buying a smaller home because they're empty nesters and they're ready to downsize. They might be buying in a different location, or they might want something newer, bigger yard, whatever it is. Most of the time people sell, they're buying another house. And the problem was, if they had a house with, say, a mortgage at 3% interest that they had gotten sometime in the fairly recent past, if they go to sell that house and then have to replace it by buying another house with a mortgage at a much higher interest rate, their payment was going to go up significantly more. So let's say somebody just wanted to move across town and wanted to buy a comparable house. They sell their one house that's, say, a $300,000 house with a $200,000 mortgage, and they buy another $300,000 house with a $200,000 mortgage. So they really just moved their equity from the first house to the second. Their interest rate has jumped so much that just by a lateral move like that, their mortgage payment has gone up by hundreds, if not thousands of dollars in some cases, depending on the price point. So you had people who wanted to sell, but didn't want to be in the position that they couldn't afford their next house because it was going to be so much more expensive. The problem was that the interest rates moved too much too fast. If your interest rate difference there was only 1%, the quality of life to go from one side of town to the other, or to downsize, or to upgrade, and paying a little bit more on your mortgage would have been bearable. But within a short number of months, the interest rates moved so many points, and every 1% move on interest rate is like 10% of affordability. Your mortgage is going to go up by 10% if the interest rate just goes up by 1. So it's really a lot more significant than it sounds when we're throwing around these interest rate numbers. And so with sellers not selling, a lot of people sitting, then buyers who were serious and were able to buy couldn't find what they're looking for, and it just drove the prices up. And it stayed like that for a while. Last few years, we've been significantly short on inventory, like literally less than half as many homes have been selling. Price points have been higher, so those of us in the lending and realty world that get paid on commissions, we're getting bigger commissions, but we're getting significantly less of them across the board because there were so few homes actually for sale that did change ownership. So with this year's news, that might change some. There might be some opportunity here for buyers. There might be some opportunities for sellers. All right, so now interest rates are coming back down. They're not crazy good yet, but they're a little bit better than they were. And again, we're expecting them. We're told that they're coming down for at least half of the year here. We're expecting interest rates to come down. And so what that means is that the buyers who've been sitting and not wanting to sell because they couldn't buy anything else, they have an interest rate that's, low maybe on their house now. They were too high of what they could replace that mortgage with, and now it's starting to come down. If those were even, there'd be a huge amount of movement in the industry, but it won't get down to 3 or 2% like it was before, or at least it probably won't anytime soon. But as it comes down and the interest rate that they can get gets closer to the interest rate that they currently have, the reason for moving is going to all of a sudden become worth it. If people were wanting to downgrade or to upgrade or to change locations, they might think, well, now it's more affordable, and even if it costs me a little bit more, it's not going to be like $500 or $1,000 more, or at least not as much as it was going to be before. And so the sellers are going to be getting back into the market who have been waiting. Eventually, they're going to be like, well, even if it cost me more, needed to sell 2 years ago and haven't because of the market, and now might be the best time to do that. So there's going to be a lot more sellers getting back into the market, I think, because of the interest rates. But of course, there's going to be a lot more sellers getting back more buyers. So the buyers are getting in because now all of a sudden they can afford a house. As the interest rates come down, people who could only qualify for 2 or 250, and there's really very little in that price range that can qualify for financing. Very few houses that will qualify for financing in that price range in a lot of markets. Well, now those folks with the same income might be able to afford $300,000 or $330,000 as the interest rates come down. Now they'll actually be able to buy a reasonable house because of the interest rates. So as more buyers get into the market, that will probably push the prices up faster. Because remember, we did go up in value on the houses this last year, even with the interest rates that we had. And so if interest rates come down and there's even more buyers, it could push the prices up, even though the affordability may get better. Remember, I said the purchase of a home is actually 2 purchases. You're purchasing a house and you're purchasing a mortgage. And so looking at a house and saying that's too expensive, if you're not looking at the mortgage that you're able to get, you're really only seeing half of the coin. And so when I'm, as an investor, looking at homes to purchase, even if it was something I was looking at buying myself, I'm less concerned with the price as I am with the terms that I can get. I'll gladly pay 10% more in price if I can get 2% off in interest, because I know it's going to save me tens or hundreds of thousands of dollars. It's the part of the math that most people don't look at. Anyways, just don't be stuck on the price, or don't be discouraged if the prices are going up, if your interest rate's going down. And if you can get into something now before they go up even more, then you still got the opportunity to refinance later if the interest rates do come down more. So if you get into something now when there's maybe less competition than this summer, it's a good fit for you as far as the house goes. Go ahead and buy that house, and then you can refinance as the interest rates come down. Hopefully they'll come down quite a bit, but if you can afford it and it's a good deal, I recommend making the purchase, because it's going to be pretty tough competition out there looking for a home this year, I believe. So anyways, hope that helped on giving you a little bit of a market update on where we might be going. I say might be because what they've told us about the interest rates may change. Geopolitical factors, stuff on the other side of the world can affect what kind of interest rates we can get, which is crazy. So, this may all change in a week, but this is what a lot of people in the industry are thinking and looking for. And if you are interested in buying a house or selling a house, please reach out. I'd love to talk more specifics about your individual house. If you're interested in investing, I've got options there for my investor meetup and coaching and things like that. So anyways, thanks for watching. Hope you guys enjoyed it and have an awesome week. If you guys have any real estate needs whatsoever, please reach out. In the meantime, please like, subscribe, share, follow, comment, and you can find me on any of these other places that you enjoy your content. So thanks very much. Really appreciate it.